Hello and welcome to the Monday Futures Market Outlook for June 18th, 2012. This is Patrick Ceresna. For those of you that have not had the opportunity to try out the eMiniSource.com trading room, 5-day complimentary memberships are available on the website. As always, we start off with a chart of the U.S. dollar index futures, and we try to recognize the primary trends of the U.S. dollar to decipher the likely weighing of the different markets. At this juncture, we continue to identify this retracement that the dollar index is doing, which by all means was just considered a normal flag or wedge formation. We do not believe that the U.S. dollar will begin some new downtrend, which means that this pullback ultimately will lead to a buying opportunity, which allows the U.S. dollar at minimum to retest its highs, but likely the next leg of a rally would be what we consider a measured move, which could easily have the length of the rally go not only back to 84 or towards the 84 level, but also could even go as high as 86, 87 on the upside if there was real momentum behind it. This doesn't necessarily have to begin in the next week or this week or even next, but when inevitably we probably into the month of July we'll see an uptrend resume in the U.S. dollar. That brings us to wanting to take a look at the euro, and primarily the euro. Obviously, we're coming off of that Greek election, and it created a false start on the upside that almost immediately reversed back down. Really, at this juncture, we continue to believe that it's the same kind of consolidation flagging formation that will likely see the euro resume selling at some point into July. Again, it doesn't mean that this week that the euro weakness is going to be imminent for a big downside reversal, but it is likely that these are the sort of levels where important consolidations over the next week or two will find their highs and subsequently reverse back on the downside. Inevitably, as that U.S. dollar is rallying, the euro could very easily deteriorate down towards even the 118, 120 level where its 2010 lows were. In the bigger picture, we would then evaluate the euro down at those levels to see whether or not the major supports come in, but we continue to believe that after this rally is over, that the euro should continue this trend. Next year, I want to take a look at the 30-year Treasury bonds, and so long as the U.S. dollar trend that we've anticipating of strength in the U.S. dollar remains intact, then much of that money will flow into Treasuries to find yield, or at least a safe haven during periods of global uncertainty in Asia and Europe. Really, at this stage, we believe that again that these Treasury bonds can still yet have another substantial move higher in spite of the disbelief of all investors. We really continue to believe that 30-year Treasury bond could find its way even up to the 158, 160 level at some point later this summer. Next year, I want to take a look at copper futures, and when we take a look at copper, all the rally attempts have so far failed. We were suggesting that we could see copper prices, even make it back to the 360 level on retracements, but every time copper has tried to rally, it's almost immediately met with overhead resistance as distribution comes back in. We believe that this is a trend in copper, and that the trend is not over, and that as soon as this little consolidation point finishes, that a resumption in trend is the path of least resistance. It will naturally see prices of copper work their way down to as low as even below 310, where the lows were back in October. We could even see prices in 275, even 250 on the downside if the selling really intensified. Nonetheless, we are looking for all rallies to continue to fail in the upcoming weeks. Next year, I want to take a look at crude oil. And crude oil continues the same trend as even copper continue to see failed rally attempts. We were suggesting that a very natural retracement could have not only easily made it back to 88 to 92, but could have even made it all the way back up to that 95 to 97 focal point. But every time oil tries to rally, almost immediately it's distributed. This continues to be a very weak market for crude oil, and at this point, anticipating further weakness in crude is still the path of least resistance here. While we could still again see short-term rallies that could theoretically make it all the way back to 88 and 90, again, from what we're seeing in the markets is that almost every rally will end up being distributed throughout that cycle. Next year, I'm going to take a look at gold futures, and similarly to our other commodity forecasts, we're skeptical of the sustainability of gold. While when gold was testing that 1540 level where it put in its lows back in December, we were suggesting a bounce back to the consolidation point from March and April around the 1650 area would be very natural. But we are now up there, and while certainly over any short-term period we could see, $10, $20, even $40 upside potential for gold, we are fully anticipating the rally to fail here, and whether it takes another week or two to do so, inevitably at some point we think that gold will at least at minimum retest those lows at 1540, if not make a move down into the mid 1400s, down to around that 1450 focal point. That brings me to wanting to discuss the weekly charts of the S&P 500. Put a chart here with 3 decades of price action, and we put an 80-week moving average on there to depict the bull and bear market cycles the market has gone through. And you can see here that we're just consolidating at that 80-week moving average. Any new round of selling in the S&P 500 would give the first bigger picture sell signal since the false starts back in 2010-11, and as well as the 2007-2008 bear market. And really, at this stage, we don't necessarily believe that if we did cross below that 80-week moving average, that it necessarily means it's going to be a 2008 style market crash. But it would certainly go in line with many of the global indices, which are already well underway in a bear market move downwards. And at some point, the U.S. market could continue to consolidate during a period of global equity weakness. When we take a look at that S&P 500 on the daily charts, you can we are really approaching the retracement zones where we were looking for the rally to go. The 1320 to 1360 kind of zone is sort of the midpoints of the retracement. And while we do believe that there's a very reasonable probability that this will be where the highs of the S&P will come in this June cycle, there is always a chance, if the environment is right, for what we call a key top retest, which lies around that 1380 level on the upside, irrespective of whether it comes off the 1347 highs from this morning or whether we first go up to 1380. We expect that this rally will fail and will bring about at minimum a retest of the lows that we put in back in May, or it can go as low as 1240 or even 1200 on the downside during the next wave of selling. Just to review some key intermarket observations, we just actually changed our short-term biases, which were all neutral last week, to actually identifying the bullishness of the U.S. dollar. We simply feel that now that the consolidation is more than complete, we are at the price levels from which we can look at the opportunity to own the U.S. dollar. And while we may not have seen the immediate signal to actually seen the breakout, we do believe at this level the risk reward proposition of starting to accumulate US dollars, anticipating that rally, is still pretty good here. At the same regard, with the predominant weakness of commodities and the situation in the currencies, we are switching back to short-term bearish on commodities to line up with our long-term bearish outlook. In the same regard, we were tempted to go short-term bullish bonds, but we more than likely will reserve that for next week. But U.S. stocks and global stocks have all reached retracement zones, which again, the risk reward proposition of even being neutral to bullish is very poor. So it's natural to at these levels to start taking a short-term bearish bias for the upcoming weeks going into July. That was your Monday Futures Market Outlook. Thank you for joining me.